Sponsored by Anthony Mendez.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon, magnificent Hines.
You didn't do that too well this time.
I know, man. I got caught off guard.
Just stick with one, like money.
No, magnificent today.
Mortgages.
I've been magnificent all week. People have been calling me, and I've been coming with answers. Right?
This is the Real Estate Report with magnificent Gordon Hines, and I'm Tony Mendez. This is kind of a special edition of the Real Estate Report. We have a great guest, Scott Weiss from. Are we allowed to say the name of your company?
Go ahead.
Oh yeah, Mountain West Financial. Been in business since 1990, I believe, here in the Bay Area and California. And you've been with him for a while. You've been in the business for 20 plus years. So we have Scott Weiss with us. We're going to talk about low down payment products and a lot of people, and the reason why I think this is a special edition, because we're going to try to get rid of some of the misconceptions that people have about low down payment products and income limits and credit score limits. And, is there really a true no down payment product, other than the VA loan that's out there? So we're going to get to some of that today. It is a call-in show, 800-516-1220, 800-516-1220. And you can ask any questions. You can email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. So rates, Gordon. Headlines. We're at over 1 year lows. The Freddie Mac has the 30 fixed at 4.41%. That's down again from last week. 15-year fixed at 3.84 and the 5-year ARM at 3.91. So I think that's kind of a revitalization. That's one of those words I messed up 3 weeks ago. Do you remember that?
Yeah, absolutely.
So I got that out of the system, and it's revitalizing the market. We're seeing a little bit more activity, I believe, in the refinance market, especially in the higher end. Jumbo rates are superb right now. The jumbo market is there's a lot of lenders competing for that market because they know, okay, $1 million loan is 4 $250,000 loans. We're really going to compete for that. I know you guys aren't Scott, you're not like the top jumbo lender out there, but I imagine that you guys you do the same kind of competing when it comes to products that you want to, other wholesale lenders are competing for.
Absolutely. I mean, we're all competing with the same product on that, with the jumbo market and with everything else.
So what do you guys specialize over at Mountain West?
We specialize in affordable home buying programs, is what our niche is for the state of California. As you mentioned before, we've been around since 1990, and our specialty is affordable home buyers, to get borrowers into as close to zero down payment loans as we can.
So in the Bay Area, I think people are affordable housing, affordable buyers. What's affordable around here? I think a lot of people will think that. I think one of the misconceptions that people have about low down payment products is that they're limited on the loan amount. When indeed here in the Bay Area, you can go as high as $726,000 on a low down payment or zero down payment product.
Correct. And the misconception is that they cannot afford it. The max sales price for this product is $765 anywhere in the state of California. And people ask all day long, well, they either make too much money or that they don't make enough money. And as an example, in Contra Costa County, the income limit is $192,000. And in San Francisco, it's $228,300 on this. So they think that they cannot afford it when in fact that they probably could afford this product. Granted, we know that the max sales price being at the $765, you're not going to be able to buy a single family home in San Francisco, but outlining areas, you can do condos, PUDs, things like that all day long.
And that fits a lot of homes, to be quite honest with you. Anything, let's just say anything east of the bridges. And we stretch out pretty far as this radio show goes, but we've been doing a lot of homes in Sacramento. A lot of people have been moving to, taking some equity, moving to other places, or they're just buying for the first time in other places around the state. where it is a little bit more affordable, and they, that $484,000 loan limit, that's for what they call the conforming limit, and then the high balance at $726 really starts making sense when, we're doing 2 homes right now in Elk Grove. One's for $362 and one's for $350, and these are beautiful homes. And there's other programs like the Fannie Mae Home Possible, and
there's a Home Possible. There's a My
Home
Neighbor.
Ready.
There's a Home Ready. Mm-hmm. They even have programs for teachers, products, first responders. There is a whole slew of products out there.
This is all the products that you guys have.
Absolutely,
Yeah.
yes, absolutely.
Talk about the CalHFA, because a lot of people, when I first got into business, CalHFA was very popular. And then it kind of waned a little bit because everybody was getting these teaser loans, and you could do first and second loan without having to have any of these income problems or credit score problems. But now that's kind of coming back because people want to get into the industry, into the market, and they want to take advantage of, here in the Bay Area, they've been paying high rent. They've been having trouble, or they have like student loans, high rent, car payment, or a lot of commuting expenses, and they're running out of ways to save money. So these low down payment products really work, and CalHFA has really been one of the more popular ones.
This product has been around for here in California forever, it seems like, and even just what we were talking about before all the Alt-A lenders came into the game and things like that. The beauty thing about this product it is a true zero down payment program. The second, which is the down payment aid assistance, is a no payment every month. It is, which is at 3.25% on the second, and then the third, if you needed the help on the closing cost, you can also get help for that too.
So you're getting first loan, and that's kind of your it could be any,
that is a normal
FHA
loan, correct?
Second loan is the CalHFA, and then a third loan
will help you with the closing costs if you need it up to the 3% on that.
And unlike down payment assistance programs where you have to wait in line, it's first come first served. This is
available to anyone who is a first time home buyer.
Yeah.
Okay, you have to be a first time home buyer, and the definition of a first time home buyer is someone that has not owned any property in the last 3 years.
3 years.
3 years.
So. Yeah. I thought were you saying something, Gordon?
No, what I was going to say is what happened over the last couple of years as the market heated up. A lot of realtors, when they see programs or buyers coming through using this program, they were just neglected. They just didn't look at them if they were viable because the cash offers, the high down payment offers are coming in. But now as the market's kind of shaked itself through, we're finding a lot of these products now are going to kind of bring volume and energy back to the marketplace. So I believe these products are well timed and well positioned, especially at the early part of 2019.
Yeah, I think it's definitely something that I think it's going to capture some of the sideline, people on the sideline looking to buy, and they're going, there's really a low down payment or no down payment product out there, and there really is. And of course, you have to follow some of the income limits. What are the income limits, for example, in Alameda County?
So in Alameda County, it is $192,800, which is amazing. And San Francisco, as we talked about, is which is at $228,300. Santa Clara is $224,300. And in Contra Costa, it's $192,800. The other benefit about this product, 640 minimum FICO score. Okay. So you have people who think that they may not qualify because they don't have the FICO score. A 640.
So you're telling me. So here's what I get blown away. And I was talking to you before the show, and I was like, okay, if somebody's making $200,000, what was the Alameda County was 100 and what?
192,800.
192. So you're making $192,000 a year, and that's household income. That's not individual. That's household income. How are you not saving enough for a down payment on a house?
It's hard living here in California.
No, I know.
We all know.
I know it's hard. I mean, I struggled for a while when I bought my first house, and I was able to continue. I live under my means. I know I do, and my wife hates me on occasion because I do, and my brother tells me I'm the chintziest guy he knows. But I've saved some money. I put away the stock market, and I do the real estate. But a lot of people who are looking at first-time homebuyers are millennials, and they're carrying some of the largest debt we've seen of any generation over the past 50 years, and or longer. And then we have higher rents. It's easily somebody spend $2,000 or $3,000, $4,000 a month in rent for a household, and especially if you have a kid, you're spending even more money. And this is kind of where this product fits in, and is designed for people who say, you know what, you don't even have to put money. You may have the money, you don't have to put it down. That's the other thing too, is you may go, okay, I'll use this just in case. You can even go in and offer and say, I'll put 20% down. Meanwhile, you go to your lender, go to us, and say, hey, listen, I'm going to get that CalHFA loan. Put no money down. The seller doesn't care how they get their money. They just you just get your offer accepted, knowing that you have that 20% down, or even 10% down, or 5% down, and then go out and get a different, the cow half alone with the down payment.
But that's always the
assistance.
challenge. We've got to convince the sellers that's okay, because a lot of times when the contracts come in written with zero down payments, people just get nervous. People like to see borrowers having skin in the game. $192,800 in Alameda County. That's $16,000 per month per family. You've got a husband and wife making $16,000. They're paying $3,000 for rent. They got 2 kids. They got 2 car payments. They got student loans that they're paying on. It seems like a lot of money, but at the end of the month, when it comes down to disposable income, they're down to a very small amount of savings. That's the reason why these programs are so important, and that's the reason why the income limits have been raised, so families now can actually take advantage of these programs. But before, the income limitation was $60,000, $70,000. You can't buy anything with $60,000, $70,000. So the programs have actually come up to speed, where it's very relevant right now to our marketplace.
Can you use these on duplexes? Say you owner occupied one side and rent the other side?
They are not. They're only for single family, PUDs, indoor condos only, because these are specifically owner occupied properties. They're not an income producing.
And a condo has to be the FHA approved condos.
Correct. They have to be FHA approved, because FHA does not do any spot condo approvals right now.
They've gone away with that?
No.
What was that thing called where they did the quick FHA condo approval thing? What was it called, Gordon?
It was
Spot
the
approval?
spot approval.
Oh, it shows
They
you
were
how much-
talking about bringing it back, but right now that's just not on their hit list.
For anybody who's using FHA loan and they want to find out if their condo is approved, you can go to just Google FHA condo approval, and it brings you up. You put in the condo name or the city name, and it tells you a list of approved condos. That's the unfortunate part, in my opinion, of how FHA does that, because there's a lot of affordable housing out there as far as condos are concerned. If you want to get your, as Gordon would say, skin in the game. And then you find out that there's like in Fremont, there's only like 20 condo complexes. Fremont's the city of condos, or Walnut Creek, the city of condos, and there's only like 5 in Walnut Creek that are approved. It's kind of an unfortunate part about that.
Yeah, it can definitely be challenging when you're out there house shopping for what you want to do.
In the past, FHA, the spot approvals that you just mentioned, where basically you fill out the documentation, send it in, and you got the condo approved during your loan process. Then they revamped it where the approvals were only good for 2 years. And a lot of times, if the developments doesn't go back in and re-update the information to HUD, they kind of fall off the list. That's the reason why you're seeing such a small amount of products on the FHA approved list.
Yeah, we saw so many inactive, or it was not a lot of declined, but inactive, where they had it approved back in 2014, 15, 16, and just kind of let it lapse. And it's unfortunate. But there are other products you can revert to, like the Home Possible or the Home Ready products, and you can do the 3% down. What's the limit if you go high balance when it's up to 726 on the Home Ready and the Home Balance?
Well, and so it's still the 726, 520.
Down payment wise,
The
I'm
down
sorry.
and so it's the 3.5% on the FHA, and it's the 3% if you go with the high balance on there.
The high balance as well.
Yes.
See, those can make sense, because a lot of people might go, I do have the money, I want to try this 100% financing, but just in case if I find something like a condo that fits this price range, I'm ready to buy it. And these products are out there. There's even products that right now, a lot of our lenders are saying that lender paid mortgage insurance the rates are more competitive than if you do the mortgage insurance with the lower rate. So we're looking at a lot of products that are out there for low down payment or no down payment. One of them is with Mountain West Financial. Scott Weiss is here today. He's the account executive for the Bay Area. We're going to come back after this break and hit a little bit more about these products here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. That's Scott Weiss. We'll be right back after this break.
Questions about real estate? Call the program. 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always call the show 800-516-1220, 800-516-1220. Email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Home equity loans in the United States cost the most in 11 years. According to Bloomberg, the HELOC average rate reached almost 6.8% at the end of last month. Well, actually, that's according to Bankrate. That's the highest the firm's weekly data showed since January 2008. Meanwhile, homeowners in the third quarter tapped $37 billion of home equity through equity lines. That's down 6%, but they're borrowing it at a higher cost. In the day, Scott Weiss is with us from Mountain West Financial. He is our rep. He's the Bay Area rep for a company that's been around since 1990. We like using local wholesale lenders. In fact, this is the second one that you've worked for since we've known you, and you like working local. We like working local. What do you think about the fact that equity? We've seen the Fed increase rates consistently for the last couple of years, and that's affected the equity line rates as well as credit card rates. Anything else that you borrow, car loans, but equity rates. You see, people tend to borrow the most amount of money out of their house, so this is affecting them quite a bit. So, in the old days, we used to have the first and second loans. I know you promoted those for a while, and you could go up to 100% financing. We just left the last segment talking about the Cal HAFA loans, which have really high loan limits here in the Bay Area for almost 100% financing when you add that Cal HAFA loan to the FHA loan. How many people are competing against like equity lines now on purchases and then considering these Cal HAFA loans or any other loans for that matter? How's it affecting your business?
Well, there's a lot of lenders that will go to 95% to avoid the MIP, the mortgage insurance, things like that. Even on jumbos, we're seeing them at 90 and at 95% on those products. With the interest rates going up, supposedly this year, what they're going to be, they are costing the homeowners more money to borrow on that. So you're seeing a lot more lenders jumping into the game that are offering equity lines, non-QM stuff, non-qualified mortgages, all this other stuff, things like that.
So it's my opinion that there are a lot of products out there, and they can get kind of confusing because somebody could say, okay, there is a commercial out there that does kind of make sense. I kind of bash commercials that banks do as far as mortgage is concerned, but there's one out there. It's like this guy goes, "Oh, you want MIP? What's MIP? You want lender paid MIP? It's like," and you get kind of confused, and they're like, "Well, I'll just do this." It does take a good loan officer, in my opinion, to figure out and qualify a client to what they really need in the long run. But you were just talking about these low down payment products with mortgage insurance, but lender paid mortgage insurance is, I think, in my opinion, is a better option than going with a second loan. And I just don't like equity lines for that reason, to avoid mortgage insurance, because the MIP factor is so much lower when you roll it into the loan as opposed to paying it monthly. This is something that we've done more often recently. How do you guys are you guys competing on that as far as your conventional products, your conforming products?
Yeah, obviously, if you have a higher FICO score, then you want to probably go with the agency with the mortgage insurance. If you have a lower FICO score, then you want to go towards more the FHA, because the monthly on the FHAs is the same regardless of what your FICO score is.
You think FHA will ever offer lender-paid insurance?
No, because they're already getting it on the upfront.
That upfront.
And then they're also getting it on a monthly. So why would they want to do away with it? Yeah, absolutely.
And that's my opinion. I'd rather go conventional. If you get your credit score up, so you can avoid FHA, so you can have that choice. Oh, I want to pay monthly mortgage insurance and then eliminate it later, or you can build it in. We have a lot of people who say, Gordon, you see this all the time, where they go, "Oh, we're just going to get a credit," and this is happening more often. A credit from the seller. We already had our down payment. We have a little bit more money now. We're just going to go ahead and take a lower rate and pay a little bit more costs.
Well, I think different scenarios work for different people, depending on how much money you have, what your credit score is. When you go into conventional loan versus FHA, like Scott said, regardless of your FHA score, your credit score, your MIP is the same. It's not the same on conventional loans. But the MIP goes on a scale from the LTV from 81% all the way up to 95%. The higher, of course, the leverage, the more the MIP is going to cost you. So it's all relative when you kind of pencil it out. You just got to make sure which makes more sense for you. The equity lines that we always talk on the show are easy to get, but you actually pay for them. You just mentioned
heavily marketed too.
They're the highest now in the last 11 years. One is the competition. Not a lot of people offer these equity lines except for the big banks. Before, your mortgage bankers, your investors used to offer equity lines. Now those products are actually gone away, so you only got one source to get them from. So, of course, they're going to take advantage of that by pricing them higher.
Housing sentiment is making a bounce back after a weak winter. So more and more people are interested in get back into real estate, especially first-time home buyers, I like these products, Scott. We're going to keep you on for the rest of the show. You can always reach us at Tony@BayAreaLoanSource.com, Gordon@BayAreaLoanSource.com. If you want any more information, you can go to BayAreaLoanSource.com. Again, these are great products for people who need low down payments or no down payments, and you can, find a house in the outlying areas. We'll be right back after this break here on the AM 1220 KDOW.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Bank Buster Jumbo. This is my quote of the week. One of our wholesale lenders, I'm sorry, Scott Weiss is still sitting here. You don't have this product, but one of our investors has something called a Bank Buster Jumbo. They want the market from the big banks out there. A lot of people have been seeing that these banks are really stealing some of the jumbo loans away from the brokers, and not anymore. And I'm very happy to be saying that we have
Buster.
Bank Buster Jumbo. With that said, interesting story. The average adjustable rate mortgage is nearly $700,000 as a balance compared to a $280,000 balance on a fixed loan. That totally makes sense. I was surprised to see it almost 3.5 times the value. But if you're getting a $700,000 loan and you're getting a 0.75% lower in rate than a 30-year fixed, and you have to get a 7-year ARM, I'm taking that risk. Now, of course, I'm in the business and I can kind of monitor rates and kind of figure a way for it to make it work. But why can't everybody else? You first saw this number and I was like, go higher. No, higher.
Right.
Yep, you're at $700,000 for the balances on adjustable rate mortgages. This was last month.
Well, I think 7 years is a lot of time actually for the market to cycle. So a lot of times people get nervous because it's an adjustable. I've offered people these rates, and compared to a fixed rate, of course, they most of them err on the side of caution for the fixed rate. But a 7-year ARM is a great product. 7 years is a long time. The average person stays in the house, I think, here in California, 5.5 to 6 years. So 7 years, most people are out. But if you're still in it, that gives the market a chance to go up and come back down to right where you need to be if you need to get out of that product.
A lot of economists or other professionals in the business, they don't really distinguish the difference here, say that it's a little scary to see that high of a balance with ARMs, because that's what it looked like in 2008. We were at about $750,000 in the average ARM balance compared to what we are today, right around $688,000. So not saying that's, we have to remember though, back then, a lot of the ARMs were also those risky loans, like the NEGAM loans, the teaser loans, and things like that. So that factor's gone, but a lot of people are getting into these ARMs. I personally, first of all, if you're going to leave your house in 5 years, why would you have a 30-year fixed, right? Why would you be paying 0.75% or a point or even a half a point more than a 30-year fixed on a monthly basis? Scott, you see this all the time. You see people saying, I'm just going to get the 30 fixed no matter what.
Exactly, because it's the old school way of thinking. It's what they were always brought up on by their parents, is to get a 30-year fix. Don't do an ARM. They think the ARMs are the more aggressives and things are going to happen. Not always.
What do you have on your house?
I have a fixed because I'm conservative.
What do you have, Gordon? I know you have ARMs.
You
have both.
I've got ARMs.
You have ARMs.
The majority of properties I have is ARMs.
And I have a 10-year, I have like 5 years left on one loan, ARM on another, and a 30-year on another. Yeah, so I have like one of each out there.
Yeah. So you're diversifying yourself.
Yeah, so I'm getting screwed one way or the other. No, I'm not getting. No, but it is interesting to see that more people are looking at ARMs. The Bay Area at one point, when I first got in the business back in 2004, somewhere in 2006, I looked at a stat that said that. Sorry, everybody. Rookie mistake. Beginner's mistake.
That's what you always say about me.
And, it's funny. I said I would turn my phone off. And
you told me to turn off
and I told
my
everybody
phone.
else to turn their phone off except for me. That 60% of homes that were being purchased in the Bay Area, they would use an ARM. It was actually like 62%, and that's down to less than 10%. So I don't know. I just don't know if that makes sense for that many people to have fixed rates if they are going to be moving. I don't know. I don't want to say that I'm an ARM guy, but there's got to be a portion of people out there that should have arms.
Well, the
more
bigger,
than
the bigger markets always tend to be fixed rate markets. Our markets, the smaller markets are more conservative. People always go with the long term fixed rates, regardless of what rates are. I've talked to many people in different parts of the country. Big markets, they're more flexible. Small markets, conservative.
Well, if you have any questions or you want to tell me that I'm wrong, you can email me, Tony@BayAreaLoanSource.com, Tony@BayAreaLoanSource.com, or you can tell Gordon he's right at Gordon@BayAreaLoanSource.com. We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines, and this is the Real Estate Report.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always call the show, 800-516-1220, 800-516-1220. We're talking mortgages, a little bit of real estate, national, local as well. Homes staying on the market for a month or longer in many places in the United States. I think the average right now is 55 days, Gordon, on the market. But 2-3 places in the West Coast, including San Jose, just hit a new highs that we haven't seen in 3 years. San Jose is up to 45 days on the market.
We've been talking about that on many shows. DOMs on the appraisals, days on the market.
Yeah.
That's a great indicator of where the market's going. Actually, that's the best indicator you can think of what's going to happen in the market on a short-term basis.
Especially it was 12 days a year earlier. So year over year, they went from 12 days on the market to 45 days. Seattle is 47 days now, up from 15 days a year earlier. And Portland is 50 days on the market, up from 28 a year ago. Definitely one of the signs that we pay attention to, especially after last week. We talked about how San Jose home prices dropped 8% year over year. Are you seeing any of this, Scott? Scott Weiss from Mountain West Financial is here, joined us. We talking about low down payment products. You're seeing some price kits a little bit, more days on the market. To me, I like seeing this. It's a little bit healthy in the market. It's kind of like the stock market, buying opportunities. People sitting on the sidelines going, okay, the home prices can't go up forever. When is the break? There's some breaks here right now.
Absolutely. And if there is a bright side to this, with the home prices coming down, it's allowing people to get into the marketplace that may not have been able to afford before. Even though that it's a 8% from what you're talking about there, it's still 8% lower than where it was last year at this time.
On average, of course. Mm-hmm. And and you got a place like San Jose, or just say Santa Clara County, where there's not a lot of building going. At least not single-family homes. So getting an opportunity to get a single-family or getting in some condos can get your foot in the door. But also with the rates have been coming down the last several months.
Yeah, the rates have been definitely on the way down. The other thing too is that it's turning from a seller's market back to a buyer's market. So the buyer is able to get some more closing cost credit if they have to from the seller, because the seller is obviously motivated to sell. They don't want to sit on the market for more than what they have to be on.
We just saw a contract 2 days ago where the seller was paying for the owner's title policy, they were paying for transfer tax, and they were paying for the escrow fee and a warranty.
And that's huge.
It was funny because the buyer, I was listening to the buyer, I was like, this is the contract you signed. He's like, they're paying for what? You mean we got this accepted? I'm like, yeah, this is something that we're seeing more and more often. So that's good news to see that sellers have recognized what's happening in the market, in my opinion. Gordon?
Well, I've got a client, matter of fact, we're in contract this week. She owns a house in San Jose. It's a duet. It's an attached, what we call a townhouse. She's actually buying a brand new house in Elk Grove. The great thing is, she said the builder came down $30,000 in price. This model 2 years ago sold for almost $600,000. She's buying it at $540,000. And it's a great deal what's actually happening, simply because signed at the time. She's going to rent her house in San Jose. She's going to get a lot more money than she's going to get. But she works from home, which is a good thing. So she's actually mobile. So moving to Elk Grove it's not a problem. And that's the great thing about when you work from home. You have different options where you can live. You go to a more affordable market. The house that she's buying is almost twice the size of her little townhouse she has in San Jose, for almost twice the space, for almost half the cost. By the way, the property she has in San Jose, I ran the comps, is worth $1.3 million.
There's a lot of options out there for people. I like the opportunities that are being presented with the lower interest rates, a little bit more inventory hitting the market. The fact that homes are sitting on the market gives you a little bit more buying leverage. I think that's a great word to use. For those who are renting, or I'm sorry, that own, that are trying. This is an interesting story that I was just kind of passing back and forth during the break. There's a startup company that'll actually buy your house at 70% of the value and then rent it back to you, giving you a 5-year option to buy the house back. Very interesting. You know, they make money on the rents, of course, and then but they also give you the equity that is earned after you go into this agreement. What do you think of that, Gordon?
Wow, that's interesting. 70% of equity. So let's say, for example,
70% of the appraised value of the home.
so the house is worth 100,000. They're going to give you 70,000. Let's say
They buy it for 70. That you rent it back for whatever that is,
Okay.
and then any value over the original appraised value during that 5-year period, you're allowed to. You can buy it at the 70% plus the equity is you get, and you just owe them.
So you're back
Like the
into you.
difference.
I guess it's a lease option type deal.
is kind of a lease option.
Sale and lease back. So you sold the property, you leased it back, and you get first option to repurchase it and pick up the equity.
Yeah, it's good for people who don't have a lot of equity
Yeah.
and people who might have some credit issues that have caused them to not be able to afford a house or buy a house or qualify for a loan. Interesting that how the market always throws something out at you, and there's there's crowdfunding, and then there's things like this that are always popping up. I think like Zillow's even, or Zillow or Truly or something like, they're getting together and they're trying to buy homes, and they're probably as a conglomerate and rent these houses back. There's always something popping up. What do you think's the next thing in the market, Scott, that the next phase that we can go to? Because we're really pushing the limits on qualified mortgage, non-qualified mortgages, which is kind of like your alternate products. I don't want to use the subprime. What's the next level for
I think what
investors
you're going to
out there?
see for the investor products, and especially for people who are self-employed, there's a big push right now, and what is called as the non-QM mortgages for bank statement products and things like that.
That's like the old self-employed.
Correct. It is extremely difficult for self-employed borrowers to go into these type of loans. So that's why that they have the bank statement option. So I personally see coming down the road, you're going to see more and more of these non-QM products out there for these bank statements and the products like that are going to be out there.
Do you have some?
We don't offer that because we're a conservative based
This
lender.
conservative payoff as far as the service, and you guys are focusing a little bit more on your QM products,
Correct.
and so on.
Correct. Yeah. I mean, our service levels are very good. For what our niche is, stuff like that.
Well, it's good he said niche. I think every company has their niche. I think good that we don't all go after the same niche, and I think that gives more variety and more options in the marketplace. We always talk about the program. It's not necessarily rates that always drive the program. It's also programs. You just mentioned that as programs change, there's always companies coming on, bringing new energy, new thought processes, new innovations to the marketplace. That makes the market very healthy, and I think that makes us sell more and do more home and close more loans.
I think it makes it interesting too. Speaking of interesting, you guys can mull on this over the break. Seniors are to blame for the housing shortage, according to a study by Freddie Mac.
That must have been done by a junior.
Seniors are to blame for the housing shortage. I think it's because they're staying in their houses longer. How about that? We'll come back after this break. If you have any questions, call the show 800-516-1220. You can always email the show, Tony@BayAreaLoanSource.com. Visit our website, BayAreaLoanSource.com. I'm Tony Mendez. That's Gordon Hines. We have our guest, Scott Weiss from Mountain West Financial. We'll come back after this break here on AM 1220 KDOW.
Tony and Gordon
Everything
are
I
taking your
hold
calls
dear
at
resides in those eyes. You got that
800-516-1220. It's the
power
Real Estate
over
Report
me.
on AM 1220
My
KDOW.
mind, the only one I know, the only one on my mind. You got that power over me.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Really appreciate you listening to the show. We have a podcast you can listen to if you can't get all the show at BayAreaLoanSource.com. They are completely updated except for today's show. That'll be up later. That's BayAreaLoanSource.com. So today we have a special guest on, Scott Weiss from Mountain West Financial, and I think I think you hit a great niche in the market, and that's the low down payment, no down payment products that Calhafa offers and Mountain West offers some other products. So what are the complete lineup of the products that you offer, if you can pull them out of your head?
So we also have the GSA, the Platinum Mortgage, which is for non-first-time home buyers as well that we offer.
What's the down payment on that?
0?
Okay, and then but the Calhafa is 0, but for first-time home buyers.
Correct.
What other kind of down payment assistance products you have?
We also offer the FHA, the 203H, which is what the disaster products are.
Yep, that's
we
become-
offer that as well.
unfortunately popular in California lately.
Yeah, we have over 60 affordable homebuyer programs that are all local. We do the MCCs as well, which are the
mortgage credit
credit certificates, which are great for first-time homebuyers to help.
You have the Home Ready and the Home
we have
Possible.
The Home Ready. We have the Steep, which is for teachers, the first responders. We are the lender that you want to turn to when you have an affordable homebuyer product.
So we've signed up with you. We use you when we have these type of scenarios that come up. At any point in time, you guys can email us, Tony@BayAreaLoanSource.com for more information on that, or Gordon@BayAreaLoanSource.com. We really appreciate you being with us today, Scott.
Thank you for having me.
I mean, these are important products. Like every Thursday, we're here from 6 to 7. We like to call it the Drive Time Special, right? Every Thursday. We love your business. These are one more programs going to help you close one more transaction, help you buy one more house.
Hopefully, and it's interesting out there that the type of people that we get response from, and it's pretty much everybody. We get many calls about people who are looking to buy investment properties out of state, in state. Can I buy a duplex here? What are the guidelines for buying a duplex? And is it the income counted towards me, or is it the rents offset the debt? I mean, it could be almost anything. And we really appreciate all the people who've contacted us over the years, and we hope we can continue to service your questions.
Yeah, we get a lot of calls from people that are in trouble, that need help, need guidance, need direction. You know,
Credit
a lot of
credit
times,
help.
credit challenges. A lot
Seems
of times
like-
it might not be a loan, but it's always an option for the future down the line.
You guys hear us talk about non-qualified mortgages, and there are a lot of people get stuck with credit events. A credit event could be anything like a bankruptcy, foreclosure, short sale, loan modification even. We do have the products with shorter wait periods for those people who need assistance in that way, where that went away for a long time. We're really happy to see that come back, those shorter wait periods, which somehow it went away when everybody needed it, right, Gordon? And now it's coming back when not as many people need it, but it is out there.
Yeah, like you said, he just mentioned mortgage MCC. I haven't heard that in years. It kind of went away by the wayside, but it's always been there. But now, as the market changes, the opportunity kind of represents itself. This is February 2019, the year of the pig on the Chinese calendar. Did you know that?
I did not.
Yeah. Every year, every 12 years, the Chinese calendar recycles itself, and this is supposed to be a lucky year, 2019, the year of the pig.
Are you buying any real estate this year, Gordon?
I have to. I have to buy. Have to buy at least one piece of real estate every year.
Is that your goal?
That's my goal.
Now, do you sell a property at the same time you buy one?
No, I don't.
So you're just accumulating.
Accumulate.
Is there an age cutoff for you?
Yeah, when I get to John Gordon Rockefeller.
Is that by any chance a gravesite?
No. That's a time slot.
Oh, time slot. Okay. Well, we appreciate again, Scott, you being here today, and you're always welcome back anytime. Any last words?
No, just thank you for having me. And if you guys have any loan questions, please do reach out to Tony and to Gordon. I've known them for a long time, and they're great at what they do.
We don't need to self-promote, by the way. I appreciate it, though. You can always email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com, or our website, BayAreaLoanSource.com. Thanks for being with us. We'll be back next week.
Next Thursday, that is.